Hello, everybody, and welcome to the latest LPL Market Signals podcast. Jeff Bookbinder here, your host for this week, with my friend and colleague, Dr. Jeffrey Roach. How are you today, sir?
Hello, hello. Glad to be on this edition.
Glad to have you. Glad to talk a little bit of economy. After talking markets with Lawrence Gillen, we're going to do a little more economy than markets this week, but we will mix in both. It is Monday, May 20th, 2024, as we're recording this. Early afternoon, you see these lovely disclosures. Here is our agenda for the week. We certainly can celebrate another positive week, as we've been doing really for all of May, even into late April. Fourth straight positive week for the S&P 500. So we'll tell you about that. Next, Jeff's going to provide some context for the latest inflation data and tell us if it was actually as good as maybe the market thought it was. Next, we'll talk economy, give you a little bit of a sneak peek into the second half outlook as we start writing our mid-year. That won't be out for another, 5 weeks, 6 weeks or so. But we are starting to lay out the draft, so give you a little sneak peek as to how we're thinking about that right now. And then last, preview the week ahead, as we always do, NVIDIA's earnings on Wednesday, no doubt the highlight of the week in a otherwise pretty quiet economic calendar. So we'll start with the market recap. Fourth straight positive week for the S&P, all-time highs for all three major indexes. We actually had an all-time high and 40,000 on the Dow. Dow's up 5 straight weeks. NASDAQ and S&P up 4 straight weeks. Here's the chart of the S&P, and you see here just straight up and to the right. Really strong bounce off of those late April lows. That pullback, you may have even forgotten it happened by now, but the S&P did pull back about 5.5%. We've gotten all that back and then some. We're even up a little bit here on Monday afternoon as we're recording this. From a technical analysis perspective, you probably need a pullback. You probably need a little bit of a breather here, but momentum is so strong and breadth is so strong that maybe it's not this week. Maybe it comes soon, but probably not right now. I never pass up a chance to put in a 100-year chart, and the Dow's
Awesome.
the Dow's 40,000 milestone gave me just the perfect excuse to do that. So this is a 100-year chart of the Dow, and you see from 1932, the Dow was around 40. It was actually 41, so close enough. From 40 to 40,000 in 92 years, if I did the math right on that. If this doesn't convince you to stay long over the long term, I don't know what will. The average average annualized gains like 9%. So if you wait out these pullbacks, you're going to get this long-term average return. It's been that way for the last 100 years, and it'll probably be that way for the next 100. Here's the 10-year yield. I put this in here because I think this is really the key to why we rose last week. The bond market's interpretation of the cooling inflation data. We're down from 4.7 here about a month ago to 4.4, and kind of holding in that range today in Monday trading. So we really want to see 4.4 or lower on the 10-year. So that really ties into the inflation outlook, Jeff, which you'll get to here in a little bit. If the economy slows and inflation comes down, really good chance that we keep yields in this range or even see them move lower.
We're in the 440s even as we record, Jeff. But I was also going to say one little thing on your 100-year chart. I was talking to an LPL advisor recently, and I was telling him about my teenager getting his first official job, where he's actually on a payroll, not just doing an odds and ends kind of job in the neighborhood. And he encouraged me, never too early, set up a Roth IRA. I might take this chart when we're done and show my teenager this graph and say, Mr. Bookbinder here reminds you, start early and you'll end well with a chart like that.
Amen. Hopefully we will all have 100-year runs in investing, although I know that's probably a lot to ask. It certainly needs some help from the man upstairs. But That is cool. Yeah, we're big fans in LPL research of long-term investing, certainly. We do, manage around the edges tactically, and you certainly have the opportunity to generate some excess returns by rotating within the market, which is why we talk about this slide here every week. But generally speaking, staying long over the long term is the way to go. And the earlier you start, the better. So thanks for bringing that up, Jeff. In terms of sectors last week, it was really all about tech. You see tech up almost 3%, but real estate snuck in there. People don't talk about it a lot, but real estate actually has a lot of tech in it because you've got data centers and wireless cell towers. In fact, those technology areas within real estate are about 35% or so of the sector. So to some extent, as tech goes, real estate's going to go, but obviously lower rates help real estate as well. So that was a winner. One of the losers last week, well, it was flat, was consumer discretionary. And Jeff, you've talked a lot about how consumer spending, we'll talk about this more in a bit, but consumer spending is now facing the headwind of consumers having spent excess savings, right, from the pandemic. So now you've really got, especially for those living paycheck to paycheck, you've really just got the sort of traditional earnings as support, not so much those stimulus checks that we're still sloshing around. Right.
Yeah, that's right. And just a reminder too, since this is a public facing podcast, it's great to continue to point traffic toward the LPL.com and the drop down for the research tab. We did a really interesting blog our team did on real estate, Jeff, as you highlighted, with data centers, but also think about long-term trends on healthcare and the long-term demand for that. That's also an important subsector within CRE, commercial real estate. So I wanted to take this opportunity to point traffic toward our LPL.com research portion of the website.
Yeah, good call out, Jeff. I mean, we're still cautious on real estate overall, but if you look within all the different segments, some of them actually look quite interesting. Maybe not office, but some of the other segments look quite interesting, and certainly we recognize there are opportunities there. Something else we've noticed recently is solid moves in the Asian markets. Right, we've been talking about Japan for a long time, but look at Hong Kong, up over 5%. One of the big economic stories last week was the stimulus in China to support their property markets. That certainly helped the tone of trading over there, and is the reason why emerging markets were strong last week. Emerging markets and developed international markets are attractively valued, but you really need more than just low valuations, and in emerging markets, we're starting to get it. So that has caught our attention. Still cautious, like real estate, still cautious on emerging markets, but an area that is starting to work. So turning to fixed income, and again, this is really why markets did so well last week. I think it's because bonds rallied as rates came down on the relatively tame CPI inflation data. You end up, I think the 10-year yield at one point was down like 15 basis points last week before it came off a little bit off of those lows. So good gains for bonds, really pretty much across the board. This isn't really good for the inflation story, but we also saw some strong rallies in commodities. Industrial metals is tied to China, right? Industrial metals surged. The Bloomberg metals index up almost 5%. Same thing with precious metals. So, it's not really an area we do a lot of investing in. But for those of you who do play in those areas, certainly the charts look really good. Well, Jeff, you and I talked about this earlier today. There's actually support from the demand side and the supply side in copper.
Yeah, it's interesting. So we often say this has been around a long time, but we talk about Dr. Copper because of its ability when you track the movements in copper to get a good sense in what's happening in business and construction, industrial demand, kind of where we are in the cycle. So that's why there is certainly some benefit of tracking copper. Can be a little bit misleading A lot of tariffs. When you think about copper over the years, over the many cycles, there could be certainly some political reasons for why you see a little bit of those gyrations in prices. But in the near term, as you said, demand seems to be an interesting story. Not quite ready to call a top there, as many analysts say. And then in addition to that, the supply constraints is certainly adding to the upward pressure.
Yeah, absolutely. And then, you got the weaker dollar, which helped international equities and commodities last week. This is really the setup you want. You want global equities doing well, right? Not just the US. And then you want the dollar ideally to weaken. And that can really create almost a perfect cocktail for rising equity markets. Essentially, the international markets and the dollar can kind of confirm the gains in the US and strengthen the foundation for US equities and, frankly, for bonds as well. So we'll keep watching the dollar. It looks like it's maybe starting to turn as we get closer potentially to Fed rate cuts. So let's turn to inflation, Jeff, and certainly that plays into whether the Fed is going to cut this year and when they'll start. So, I guess we'll start with just, maybe put the CPI data last week into context. What does it mean for the Fed and this inflation trajectory that's so important for markets right now?
Yeah, so the reason why I circle, if you're looking at the chart here, right to the right, I have that 2.13 circled. That corresponds to the stickiest components of inflation. So taking out food and energy, the volatility there, taking out the housing component, since some of that is somewhat of an imputed number. It's not a real number that hits consumers' pocketbooks. So that core CPI X housing, Fed has often called that in other market participants and investors call it super core. What I like to say is, instead of adding more to the jargon, what I just say is it's the stickiest and stickier components. And that's why it's so important to watch that. We saw that start to ease up last week, and that's why we saw yields, particularly on the 10-year dip low in a pretty sweet spot, as you said earlier in the podcast, Jeff. One thing I think is interesting, for those healthy eaters among us, outright declines in prices for fruits and vegetables and meats. So you're starting to see things ease up a little bit. Now, granted, on a levels basis, where we are today relative to where we were February 2020, clearly pretty dire straits there. But in terms of watching the rate of change, that's what matters most in terms of Fed policy, because of the rate at which the banking sector looks at the Fed and where their Fed funds target and all the ramifications that goes into CD rates and mortgages, et cetera. That's why we look at rates of change, even though it can be a little bit confusing and frustrating when you think about all the dollars you're spending at the grocery store still, and when you see your latest auto or home insurance bill. But I think that the 2.13 is something that markets certainly applauded, and something that we've been talking about. I think our expectations as we think about the latter half of the year is that inflation clearly is easing. We're starting to see that. Now, granted, the upside surprise in January didn't ease up because we had upside surprises in February. We had the same thing in March. So I think we're not necessarily saying this is a convincing kind of report. I think Fed's going to be saying, all right, great, we had 3 bad months. Now we need a few good months to offset that. But markets responded and said, all right, well, maybe there is hope. The Fed can actually ease up on monetary policy later this year. This report says, hey, we're making that more likely than where we were even a week ago.
Yeah, and they still have a few months to look at these numbers before they get close to the election. So still could sneak in a cut before November. I know a lot of people think they'll hold off doing anything right before the election. So maybe September, December are the 2 cuts, or if not, if it's just one, maybe just maybe just December.
Yeah,
So
yeah.
you mentioned sticky inflation, Jeff. So this is another look at that, more of a
Yeah, just a key takeaway. We don't need to necessarily spend a lot of time on that, but it really is, it just kind of explains some of the narratives that's been, going back and forth, particularly in the last 2 months. And that is this, that, this timetable where we thought, okay, the Fed could potentially ease sometime this summer. That clearly is not going to happen because of the stickiness that we're seeing. And these gray and orange lines are basically saying, hey, what does the trajectory look like? 3-month annualized, 6-month annualized, and then that darker blue line, the year-over-year number that gets all the attention. And the argument is, do we believe the uptick in the annualized shorter term numbers, and the markets, I think rightfully so, in my view, it's an aberration. We're going to see inflation below 3% on a fairly stable level, later this summer, and so that's where you saw that flatlining, the gray and orange. That flatlining is what created a little bit of exuberance, or maybe a little less pessimism in the markets.
Yeah, that core services ex housing year-over-year number is still in a pretty good spot. So if you can just stabilize these short-term readings in the near term, those inflation numbers could look pretty good.
Yeah. It boils down to the debate, were those hot prints, particularly in January, a sign of a new trend or not? That's the crux of the matter. I think it's not a sign of a new trend. Clearly, certain investors did. Hence, you had that choppiness, as we showed in the very beginning of the podcast, with that 5% dip.
Yeah, if those car insurance payments keep going up the way they are, some people are going to just get rid of their cars. So that'll stop one way or the other, because those are some of the biggest inflation numbers I've ever seen. I also noticed. So my daughter took me to Sweet Green, the salad place, over the weekend, and when I was going into the office 5 days a week, I would sometimes eat at the one downtown, and I remember the salad I used to get was about $10 right before lockdown. That same salad 4 years later is over $13. So there's an example, and I know there are many others, of a 30% increase in price from, let's call it December 2019 to to present. Right?
Yeah.
Inflation is cumulative, so even though it's slowing, it's still a drag on consumers' pocketbooks right now compared to where it was a few years ago. And this is, I think, related to why Biden's not doing better in the polls. Just remember, inflation and income are historically very good predictors of election outcomes. So, of course, it goes without saying that Biden wants to get prices at the pump down. He wants to get inflation down in general, and needs that real income, inflation adjusted income, to rise, and lower inflation could help him do that. So it's a little early to look at the election, but it's not too early to look at the second half, Jeff, because we're in the back half of May. So we've just put together our first draft for the mid-year outlook, probably earlier than we should have, but that's what we did. So I thought it'd be kind of fun for you to give folks a sneak peek of your take on the economy in the second half, and then tie in the weekly market commentary for this week, which can be found on LPL.com.
Yeah, so much of this is tied to, how much do we feel like consumers have pulled forward demand, particularly on goods, and that spending splurge, right? Partially driven by excess savings, partially driven by just extra cash that a lot of homeowners got when they refied, and the magnitude of that influence. And so, our point is that eventually that is going to show up in the numbers. The fact that we have seen particularly really, really hot growth numbers last year. And, our view is that that's hard to sustain, particularly when, we are starting to see these excess savings dip. And so, you think about where we sit here in April. We got retail sales numbers, as you said, were recording this in the afternoon on the 20th. So last week we got retail sales numbers. Some of the important line items we call the control group helps us think about where the economy is going into the second quarter, how comfortable consumers are, because they're the engines, the growth engines here of aggregate demand, going out, buying services, et cetera. We're starting to see that slowdown. So April retail sales control group was a little bit soft, meaning that in the gray area of these boxes where we say it's not a dramatic downturn. We'll have a little bit of a uptick in Q2, and that's why you see a little bit of a growth after the surprise of Q1, where inventories and trade had a pretty nasty drag on growth. That'll reverse a little bit in Q2, but we're definitely seeing consumers starting to slow down. They've said that buying plans have slowed down. So that's the key takeaway here. The good news, though, is barring any exogenous shock, we think that this slowdown could be fairly measured. That would be somewhat of the soft landing. We think that's certainly a newer view on things. One thing that I want to tie in this graph with the comment about inflation. So basically the stickiness of inflation, we've talked about how that kind of pushed out the Fed's timetable. I think in the same way, the excess dollars that consumers had access to pushed out the timing of a slowdown. So Fed's timing pushed out, slowdown pushed out. We'll start to see that, I think, the latter half of this year. And we explain that when we will publish, I think, soon after the July 4th weekend, right? Or that July 4th holiday. I think that following week is when we actually will publish our mid-year outlook for 2024.
I think that is the tentative plan. Wait for confirmation because we sometimes push that date around. So slow economy, but it certainly doesn't sound like the recipe for a recession, which is good. I know one of the biggest reasons why the consumer has held up so well is because of the mortgage refi boom. So what is this chart telling us, Jeff?
Yeah, well, I think this is a little bit of a sneak peek for those of us that anticipate and look forward to digesting and parsing out every word that comes out of the Jackson Hole Economic Symposium, where global central bankers from around the world show up, hosted by the Kansas City Fed out in Jackson Hole, Wyoming. Very, very important conference for investors because central bankers use this as a platform to communicate a lot of things. Their topic this year is reassessing and reevaluating the transmission of monetary policy, meaning, okay, we raised rates pretty aggressively. Nothing happened. Well, that's a little bit simplified. The point is, Fed raised rates aggressively in a very short period of time, and we didn't have any potential cracks or any emergence of cracks in the system. Consumers kept spending, businesses kept growing, markets kept rallying. Well, how does that happen? Bottom line, the economy is less interest rate sensitive now than they probably have ever been, particularly because we have a lot of fixed rate mortgages in the system. We also have a lot of homeowners that aren't even mortgage holders at all. They're without a mortgage. That's the orange portion of that bar line. And so it's just important to remember in this sense, the magnitude of influence of an economy right now that's less sensitive to interest rates. Hence, central bankers around the world will want to talk about that and that transmission mechanism at the upcoming Jackson Hole Symposium. When I say upcoming, that's not until mid to early August. But in my view, Jeff, it's never too early to start talking about Jackson Hole.
That's been market moving before, and who knows, maybe it will again. I guess, this doesn't mean that monetary policy doesn't matter, right? You still are influencing the economy, maybe not as quickly, but you're still influencing the economy over time by having a higher rate. And we've now been presumably above neutral, right, in a restrictive rate stance from the Fed for a while. And it's we're going to stay there for a little bit longer. So,
Yeah.
it will contribute to cooling inflation, but maybe not as much as the Fed had expected it to if you go back 2 or 3 years.
Yeah, and then I think the key will be, as you said, JB, we still do believe this is extremely important. All the tools at the disposal of these central bankers, but we're realizing that if you have a portion of the economy that's less interest rate sensitive, then monetary policy will influence different areas of the economy very differently. Hence, that's kind of the key takeaway, particularly for business owners, understanding your customer, right? Knowing what segment they're in. Are they going to be most sensitive to an interest rate change or not? Some have not. And that's kind of the key. It's a very heterogeneous impact from monetary policy.
Absolutely, which kind of feeds into the idea of a rolling recession, which we
Yes.
kind of already had that. So this chart, Jeff, I know tries to put in perspective how big the refi boom was and how much people kind of got in their pockets from financing.
That's right. So it's no surprise that we had a lot of refi activity, but we had to wait a little bit till more data came in on some of the granular components of what was happening in the last few quarters. And what's interesting is to realize the magnitude of influence that the refi activity in recent years was in greater magnitude, higher than even pre-Great Financial Crisis, when mortgage lending standards were quite low. Now, granted, you almost have a little bit of the best of both worlds. We had much tighter lending standards, as we all know, looking at the Senior Loan Officer Opinion Survey that the Fed puts out. But in contrast to what we've seen in past, we had tightening standards, but still, of course, that was post the implementation when the Fed started hiking. But we had a pretty massive refi boom, and the bottom line, the key takeaway here is millions of people have a lot more money in their pocket. And that's why I put there the monthly payments on average of $220. Clearly, a lot more. This is a median across the whole country, but you put that amount across the country, that gives folks, in addition to excess savings, the ability to pull forward demand and spend a lot more than what we typically saw as trend growth for both services spending and goods spending.
Yeah, the stock market probably pulled a little of this good news forward too, because we have been on quite a run, as we talked about earlier. So so this is a big lift. I think this is a really important point. I often cite the financial obligations ratio because people were able to refi. They're locked in at lower percentages of debt service costs relative to their disposable income. So there's that orange line, right? That's the mortgage piece. But even the other piece, consumer debt service ratio is not, it's kind of range bound.
Yeah, that's right. It just kind of shows you that, what this is the reason why Chair Powell's premonitions and forecasting did not come true, right? Hey, we need to be aggressive. It'll cause some pain. Well, it causes pain for some people, but not broadly speaking, because of this right here. You have historically low debt service costs on your median household, and that certainly has protected the households quite nicely. It's provided a nice cushion. Hence, markets have responded favorably because of that cushion.
Absolutely. So let's move on to preview the week ahead, Jeff, before we wrap up. So, I mean, it's all about NVIDIA for me. Maybe I'm biased as an equity strategist as opposed to an economist. You probably are, more interested in some of the data, maybe the Fed minutes. What should investors be watching for this week on the economic calendar?
Yeah, I'll be watching and parsing the minutes. I'm not sure if the minutes are going to do much like they have done sometimes in the past. We've had so much Fed speech the last week, and of course there was
more this week.
Sorry, and this week. But you think about how much additional information we might get out of those minutes. We've had a pretty chatty Fed, you could say, and so I'm not sure if there's a lot more additional information might be fleshed out a little bit more. I'm interested in the new home sales numbers on the 23rd, because residential investment was very important, added to growth in the first quarter, probably continue to add to growth the rest of this year. But I'm going to be watching and closely looking at the new home sales numbers, just because, as you know, Jeff, when we heard from D.R. Horton, Pulte, Meritage, some of those folks that have in-house mortgage financing, perhaps interesting way to offset the headwinds from high mortgage rates. It's a lot better when you have in-house mortgage financing. But we look for residential investment to continue to kind of hum along, and this will be something I'm watching closely month in and month out on the new home sales. And then I'll say this, Jeff, you and I talked about this earlier, but University of Michigan has given us some inside scoop on the psychology of the consumer. Where are they feeling the pressure points? And it's interesting. This is a revision, or more data has come in. This is the final estimate for the month of May. We get a preliminary estimate earlier when University of Michigan has enough survey respondents to put their index together. But as more and more data come in, they finalize that estimate. But University of Michigan 1-year inflation expectations still 3.5%, not good. That's the tough part. So again, this is the perception from consumers, not the actual numbers, of course. But it's certainly important for kind of the expectations of how comfortable consumers are feeling going into the summertime and going into the latter half of this year.
Yeah, I guess consumer confidence in general has been a little bit soft too, but that can sometimes be a contrarian indicator. I mean, people generally will just complain, frankly, almost no matter what the environment looks like. So I'm not sure that survey is necessarily bad news. I mean, it's a bad number. It's been going in the wrong direction. But I wouldn't interpret that to mean that inflation is going to just reaccelerate and kind of take Fed cuts off the table.
Yeah. Well, it actually is a good reminder that this has been the case really for the last year at least, where you can listen to what businesses and consumers are saying, and then you track the money, right? Watch where the money goes. And there's definitely been two very different stories. People have been pretty pessimistic in the surveys, but if you track the money flow, watch what they're doing, watch what they're spending, clearly you can see they're spending those dollars. They're not as pessimistic as they say they are with their words.
Yeah, and I'm sure, I mean, the homeowners, like we talked about before, are probably, seeing the world through rosier glasses than the renters, and the higher income levels are clearly carrying this economy more so than the lower income levels. So that's something else to think about. We look at overall numbers, but certainly there is some dispersion depending on how you slice and dice the data. So that all said, we still want better inflation expectation numbers. Hopefully we'll get them, but it might just take us a month. We'll see. So beyond that, it's earnings and Nvidia on Wednesday. So we'll be watching that really closely. That stock is big enough to move the market and to move all the AI names. So certainly rather see them move them up rather than down, but that won't take away from the fact that this has been a great earnings season. I'll probably recap all the numbers for you when we're back next week. So we'll be recording next week on Tuesday after the Memorial Day holiday. So we'll use that opportunity and this opportunity to reflect on those who gave the ultimate sacrifice for our country. We thank them for our freedom. So thanks, Jeff, for the bringing the economic content to the podcast this week, and certainly mixed in some markets. Dow 40,000, 4-week win streak for the major averages. Pretty good market. Let's hope it continues. So thanks everybody for joining. As always, we'll be back with you next week for another LPL Market Signals. Take care, everybody.